Welcome back. I'm Charles Lewis, the Austin area realtor who brings you topics and discussions that will help you make better decisions when you buy, sell, or invest in real estate. Today, I'm with my friend, Chad Christian from Security National Mortgage. Chad, thanks for being with us today.
Oh, thanks for having me on, Charles. I appreciate it.
We're going to talk about today something that I'm sure a lot of people would like to hear about. We're going to talk about ways that you can reduce your interest rates. If you don't know, interest rates have what, doubled in less than a year?
Oh, yeah. In less than 6 months.
Beginning of the year, it was like, what, under 3, right?
Yeah.
What's the current rate?
Right now, about 7%.
So we have actually doubled in a year.
Yeah.
But that doesn't necessarily mean that you're locked into that.
Correct.
What are some ways that someone could potentially lower their interest rate, Chad?
Well, I'm glad you asked, Charles. There is one popular program right now, and it's the 2-1 buy down. And a lot of sellers, builders are offering it if a home sits.
Oh, yes, absolutely. I mean, literally, any house that's been listed for more than 30 days, they've got it in the description. Builders,
Yes.
every single one of them offer it. It's a very common option.
Yes.
Walk us through it. How does it work? What does 2-1 buy down even mean?
Let's say that your note rate is 7% current interest rate. Okay. And you're a potential buyer, and you can't really afford the 7% interest rate. You're just starting in your career, you're making good money, but you know that the next few years you're going to make more. Well, a 2-1 buy down would be perfect because the first year, your interest rate's actually going to be 5%.
So 2 percentage points lower than the
Correct.
7. Okay.
Correct.
Okay.
In the second year, it goes up to 6%.
Which is 1% lower than the current rate.
Correct. And then it'll stay fixed on the third year at 7% if you don't refinance the loan.
So basically you would have 2 full years before it would go up to the current rate at 7 or whatever it might be.
Exactly.
Okay.
Exactly. And it'll give you time to get used to the mortgage payment first of all, and then if you get promoted, you get extra income where you can still afford that payment as it increases, or you have the option at any point during the loan to refinance it.
Sure, absolutely.
And that is more what people are looking to do in this current market that we're in with rising interest rates. But, recession, they're talking about is right around the corner, which in turn usually drops interest rates, or so we at least hope.
Well, that's true. I mean, nobody really knows what's coming, but I think that if anyone were to look historically, and you'll notice that it stays pretty consistent, there aren't any real wild fluctuations until you get up to where we're at. You'll notice that from 2010, we've been under 5%.
Yeah.
And if you get all the way up here, then it shoots up to 7, maybe higher. We don't know. The Fed's still going to be raising rates. But what this option gives you is an opportunity to get into the house that you want, because here's the other thing that's going on. As the interest rates are going up, sellers are becoming much more aggressive in trying to find a buyer.
Correct.
Not all, but there are certain motivated sellers. If someone has a job transfer where they have to move, they need to sell that house.
Correct.
So you're going to see the price being reduced. That's the first thing they do. Ideally, what you could do if you're in the market is buy it for less than what it was worth a year ago, probably less than what it's going to be worth at some point in the future, probably near term, right? At an interest rate that's actually below market value. And here's the best thing. Who pays for this 2-1 buy down?
Oh, the seller does.
The seller pays for the buy down.
Yes. Yeah, that's the big thing, and I'm glad you brought that up. And at any point, let's say you're in the 2-1 buy down your first year. Well, the second year, now this is prepaid interest by the seller.
Okay.
So that is money that's already been paid for upfront for the first 2 years. So let's say you buy the house, first year, you're on the second year, rates are lower than what your rate's going to be that year. You can take advantage of, obviously, the appreciation that's going on. Should continue somewhat, not at the rate it was the last 2 years, but
there is an element of risk associated with it, but on the other hand, there is a lot of kind of security baked into buying real estate. In other words, if we do see price reductions, we've probably already entered that period.
Yeah.
And the likelihood of that extending for 2 years or more, yeah, I mean, it could happen. I mean, it happened back, in the late 80s with the oil bust. But the likelihood of that happening in a city like Austin, in my opinion, pretty remote possibility.
Yeah.
But on the other hand, someone that wants to buy a house needs to make that analysis for themselves.
Yeah.
What's the math? 1 percentage point is roughly equivalent to 10% in the loan value, correct?
Correct.
So with 2 percentage point reduction for that first year, someone could increase their buying power by a factor of what? 20%, correct?
Correct.
So let me ask you this question. I mean, just as people are probably thinking through this, income, credit history is in line, right?
Yep.
But with the 7%, someone could only qualify for, I don't know, let's use a 20%, $400,000. 20% more than that would be $480,000, correct?
Right.
So at the lower interest rate for that first year, they would then potentially be qualified to purchase a $480,000 house?
So you have to qualify at the note rate.
At the note rate. Okay,
Yeah.
Okay, got it.
But there's a lot of people that can still qualify
Correct.
at that 480. They just don't like the payment shock
Right.
of what a 480 payment is at 7% opposed to 5%.
Right.
So that is the big thing is for somebody that wants to maximize their budget, they can do so and still have an affordable payment the first 2 years.
Gotcha. Absolutely.
Which this loan program is designed mainly for you to be able to refinance it within that 3 years.
Correct.
It's kind of like an ARM.
Yes, very similar. Correct.
So the only thing that's different between this and an ARM is it's fixed for a certain period of time in the beginning and then it starts to adjust. Where this is, it starts at 2 points lower than your note rate and will increase the first, second,
Right.
and then stay fixed the third year.
So in other words, if interest rates are at 15% in 2 years, you're locked into 7.
Yeah,
right? So that's a good
exactly.
thing.
Yeah.
With an adjustable rate, there is a possibility that it would go up.
Yes,
I mean, right.
and that's why I want to bring up the ARM is a lot of people get nervous about a 2-1 buy down thinking that it's an ARM, and it's not.
Correct.
It's more to your benefit than an ARM could potentially be.
Right. And just so you know, the reason I was asking about that price, what I qualify for, is that no mortgage originator or no lender is going to intentionally put you into something they know you can't afford. So in other words, as you said, you have to have the income to qualify at the market rate.
At the market rate.
So this buy down is not necessarily going to be able, or wouldn't, similar to what happened in other markets back before 08, right? Where someone is in a loan that they really can't afford, but the adjustable rate made it possible for them to pay.
Now, that's not all buy down programs. So you can get a buy down on a VA, a conventional, FHA, USDA. VA, you can qualify on the buy down rate.
Okay.
So for all the veterans out there, you can use it to qualify.
Well, that's certainly good to know.
Yeah.
So what I'm hearing you say then is that the type of loan would have different restrictions or ways that you could use this buy down.
Exactly.
Well, one other question is that just so we understand how this goes, typical process is someone's going to come to you, get an approval. Correct. You're going to say they're approved for X amount at the current market rate, 7%. Correct. They're going to go shopping. They're going to find a house. Whether or not that seller is willing to pay for it or not is going to determine whether or not they could use the 2-1 buy down, right?
Correct.
My question is that how does that process work? Let's say that they found a house that the seller is willing to pay, or it's actually they've already offered it, the builder or whatever. They would come back to you, right? But there isn't any additional qualification involved.
No.
Right? Okay.
No. We're going to qualify them based off of the 2-1 buy down.
Okay.
That's what their qualification is going to be. And now, obviously, like you said, the seller, builder has to be able to or willing to participate in paying for the buy down.
Correct. And just so you know, if you haven't been house hunting for a while, the way it usually works is they offer it because they don't necessarily have to reduce the cost of the house.
Correct.
But if they've already reduced the cost of the house and then you submit an offer that's accepted, and we're able to negotiate that they're willing to pay what is it? You said it's roughly what, 1% of the value of the loan or something?
It's 2%. It's usually 2.25.
2.25. So for every $100,000, you're looking at about $2,500.
Yep.
Right. So $400,000. That's going to take you up to what? 10-ish or
10-ish, yeah.
Okay. So and what I'm getting to is that seller would need to be willing to offer that additional $10,000 in concessions because, as you said earlier, it has to be paid by the seller.
Correct.
And of course, if you do sell the house, refinance, whatever the case might be, during that 2 years, the seller gets that interest refunded, right? Because you said
the seller doesn't. It goes to the mortgagee or the.
Well, there you go. You win all the way. So, so you could actually, if things worked out, you sold the house at a profit and all that, is that you would get that back. I misunderstood that part of it.
Yeah. No, that's a big benefit to it, and you can turn around and refinance it the second year. And just for simple math, if it was a $400,000 home, the first year you'd save close to $500 a month.
Mm-hmm.
The second year, you're going to save close to around $250 to $80 a month, which is big.
Yeah, that's pretty big.
It's huge.
Would give you an opportunity to pay down some other debts in preparation of that second or the third year. All right, well, great. Well, listen, thank you so much for stopping by today.
Oh, thanks, Charles.
Any parting thoughts before we wrap this up?
No, I think we covered everything, and you feel free to reach out to me if you have any mortgage questions.
Any mortgage questions, you could contact Chad. If you want to talk real estate, you can talk with myself. Or if you have any comments on the videos that we're doing here, anything that we might do to improve or topics that you might want to see, shoot us an email or make a comment in the comments below. All of our contact information is in the video description, so feel free to reach out. And until next time.